Fuck it. Today, I'm finally breaking down my trading strategy step by step. A lot of you have been asking, and this is the exact approach that helped me make over 7k in under 2 weeks. Not through luck, but through a simple, systematic, and repeatable process. Nothing complicated, nothing flashy, just structure, discipline, and data-backed execution. And I'm not talking about one trade. I'm talking about consistent performance, the kind that only comes from showing up and following the same process every single day. So the entire profitable strategy is divided into 3 parts. Number 1, we have the strategy itself. Number 2, it's the risk management. Number 3 is the trade management. Now, to begin with, we're going to talk about the strategy. When it comes to the strategy, the time frames matter a lot because every time frame within my strategy has a purpose. The higher time frame, which is daily, H4 and H1, is to understand the direction of the market, mark the supply and demand zones, and look at liquidity pools or efficiency levels that could work as targets or point of interest to get in a trade. Then middle time frame, which is M15 and M5, they are there to map out time-based liquidity. So it could be previous day high, previous day low, Asia high, low, London high or low, New York session high or low. These come under time-based liquidity. Then you have session objectives and trend, so basically marking the information provided on the higher time frame in a bit more concise manner. And I'm going to be showing you how to exactly do this. So once we know the bias, once we've done our top-down analysis and price has tapped into a point of interest, then on the lower time frame, it could be M3 or M1, we wait for a lower time frame confirmation and enter with precision. Now I'm going to show you how to put all of this information together through one of the trades I took to make these payouts. So this is a trade that I took on 7th of October on Euro USD. So I start on the daily time frame. This time frame, I don't spend a lot of time on it. It is basically utilized to do a quick scan to identify the trend, any recent supply zones that I can utilize in my trade. Now, looking at the trend, we clearly see lower highs and lower lows forming. This is a lower low. We had a bearish break of structure here, a new lower high, and a potential new lower low. We've not had this break of structure yet, so it is a potential lower low. We also know on the daily time frame, this entire trend line was also induced, so that is good fuel for the market to potentially go more bearish. Now on the daily time frame, the supply zone is kind of far away, so it's not going to be utilized in the trade that I'm taking right now or the session that I'm going to trade. So what we're going to do is we're going to go down on H4 and trying to find something that is more precise, more concise, and closer to the current price action. Now on H4 time frame, we clearly have a supply zone which is much closer to the current price action. So we have marked that up. Now once that is marked, let's look at liquidity pools and what the swing highs and lows has induced. So what this swing low did actually was it induced major liquidity, tapped into an imbalance, which is actually a good objective taken. Now it's got enough fuel for the price to get pushed higher, which it exactly does. Now what it does is it goes higher, it induces a lower high, more liquidity induced, gives a bit of a reaction to the downside, only for the price to get pushed higher. Now that push up was for one of the reasons, and that was to fill out this efficiency point. And if you've seen my previous videos, you'll know that efficiency levels as points of interest or take profits. However, we're going to zoom in and we're going to actually see if it actually tapped into it or missed it by a few pips. So I'm going to remove this one, and we really need to zoom into this. Now you can see that actually this high here, the VIX actually failed to tap into it and it missed it by almost half a pip. Now this is where the advantage of trading correlated pairs come in. So what I did was I checked GBP USD, and if it had actually taken the efficiency level, the Euro USD missed to do it. So what we're going to do is quickly check GBP USD. We know that this efficiency point was formed around 23rd of September at 1 o'clock. And what we're going to do is we're going to check the same one on GU on the same time frame. So this is the one, 23rd of September, 1 o'clock. GU actually managed to take the efficiency and actually push the price a bit higher to tap into the supply zone. Euro USD hasn't tapped into it, but GBP USD has. It's only one pair that actually has to do it. It also works the same way in liquidity. So if one pair has induced some sort of liquidity or taps into a point of interest, the other one doesn't necessarily need to do it. And you can rely on the one that's done it to take trades off of that. All right then, and coming back to this, what happened? Let's just do a quick recap. Liquidity taken, GU tapped into the efficiency level, then it starts to reverse, changing the sentiment and forming internal lower highs and lower lows by breaking past the previous higher low. Now moving down the time frame on H1, we can see that the price at the low here is only reacting off a trend line. It hasn't induced it completely to go bullish, So this bullish reaction is only a pullback towards this efficiency level here. And price from this point on will most likely give setups to trade further bearish. Now, as we come down the time frames and we start to focus on what the current price action is doing, now at this point here, we actually have a session POI to go bearish from. That could be the efficiency point that is present here within the market. So you have this efficiency level. That's your POI number one to go bearish. Then another one is this one here that the price could actually tap into and give you lower time frame confirmation to get into a sell position. Now, what we got to do is, additionally, this swing low is a very evident trap as well. So we're going to mark that as a trap. And most likely, a lot of buyers will try to get into some sort of a buy position once the price taps into this. So now price is at our point of interest. All we got to do is wait for the correct time to kick in and also a lower time from confirmation, and then we get into a sell trade. Now you can go down the time frame on M5 or M3 and make the zones of point of interest more concise, but I think for this trade here, M15 point of interest works really well. Now what we're going to do is we're going to go down the M1 time frame and we're going to wait for our trading window to start and to give us a confirmation. Now this is right before London starts. If an entry confirmation is given here, I would take that trade. But if, let's say, price wants to go higher, tap into the second point of interest and then give me a confirmation, that works fine as well. So what we're going to do is we're going to play the price a bit, because few minutes before London opened, it actually gave us an entry confirmation, and I'll show you exactly which one. Now London has started. I think we're a couple minutes into London now. Now we had a divergence between EU and GU, and that divergence was between these two structural points. So you have your SMT here. This was 238 and 243. If we go to M1, we have the same happening here. So one is actually manipulating while the other one is mitigating, and mitigating one is often the stronger one to take. So that's what we're going to do. All we got to do is wait for a break of structure of this low to confirm the intent of the bearishness. And then what we do is we enter for a sell position. And I think I entered somewhere around here. Now, once that divergence was confirmed, I entered on this candle here. My stop loss was at the start of the divergence. That's a pretty tight stop loss. And for my trades, they usually vary from 3 to 7 pips. And that allows me to grab an average move of 20 to 25 pips. In this case here, my stop loss was 3.2 pips. And I managed to grab almost 18.4 pips move. Now, it was as simple as that. Basically, that's all you need. And you'll see that the price, after making a bit of a deep pullback, eventually goes down to hit the target. That's a whole 5.75 risk to reward bagged. Now, most traders go wrong because they overcomplicate everything. They jump from one strategy to another, switch time frames every other day, and constantly change their approach. And when you can't repeat your process, you cannot repeat your results. Now, that was the first part of the profitable strategy. The second part of it is your risk management. Now, when it comes to risk management, I'm pretty consistent with the risk percentage per trade. I usually take 1% of my capital unless I'm trading the winter market like December nowadays, when there's less liquidity in the market and extra manipulation. That's when I will have a slightly different risk management. I probably lower my risk a bit and tackle the market a bit differently. Now, that's everything you need to handle before you enter a trade. But what about after you're in a position? How do you respond once the market starts moving? That's where the trade management comes in. And this is the part that most traders actually overlook. And without it, trust me, you don't have a profitable trading system. Now, about managing this trade, every trade of mine will have a break-even point where I move my stop loss to entry. I don't take any profits off unless I'm, targeting a risk to reward of more than 1 to 6, 1 to 7. Then I'll take some money off the table. Otherwise, my break-even just means I'm moving my stop loss to entry and letting the trade run risk-free. On this one, when price moved to R, I moved my stop loss to entry. It did give quite a few deep pullbacks, as you can see, but nothing too crazy. It didn't go into drawdown either. My profit target was the start of the trap, so as soon as the trap got hit, that is when I was completely out of the trade. Now, I knew that the trap would be eventually taken, and it would have given me a bigger risk to reward, but 5 risk to reward on a single trade was more than enough for a day. And you can see that eventually it goes all the way down, induces the entire trap. While it's trying to do it, obviously it's giving buying opportunities. Some of the buyers are getting trapped into that. But eventually, now that's the start of New York, and you'll see that eventually it gets taken out. There you have it. Took a bit of time, but eventually got taken out. Now, your setup, your risk, and how you handle yourself once you're actually in a trade, that's the whole foundation. That's exactly what I've explained in my Euro USD trade. You really don't need anything more than this. But do ask yourself, is your strategy something you can repeat the exact same way every single day? Do you actually know your risk before clicking buy or sell, or are you still going off feelings? And thirdly, once you're in a trade, do you know how you're going to manage it so you can squeeze the most out of the move? If you can answer those honestly, you'll know exactly where you stand. And that is it for today. I'll catch you in the next one.